The CPI number came out at 8.2% last week. Today's video, we're going to do a deep dive into shelter, which is 33% of the CPI number. That article and opinion and a couple of FUD articles I want to show you out there, all today in Real Estate Daily. Welcome everyone. My name is Troy, and every day we go over the latest news in real estate, housing, and the mortgage market. Now, before we jump in here, let's do me a favor, hit that subscribe button, boom, boom. And then of course, you're gonna like this, and I do appreciate the comments that have been coming in. I saw a few of them on Friday. Fantastic. If you could be a little more precise, I'd love it. Otherwise, I'll respond to them. I love that we can mix it up a little bit. Now let's jump right into it. Now this was an article from last week at CNBC. It says CPI numbers show rent growth accelerating while real-time figures reflect easing. So when we look at this, at the numbers, we look mostly at rents, and that's what the government does when they look at shelter. And shelter isn't so much precise rents. I mean, they don't go to associations. What they do is they take surveys. Now, if you are in certain cities, you know that rents have been frozen now for years. So this number already is not even a true number. For an example, here in Southern California, if you own property in the city of Los Angeles, they froze rents, and they're freezing rents into 2023. So imagine that for the last 2-3 years, you haven't been able to raise rents. Now you can evict, yes you can, but you can't raise rents. This is ridiculous. We continue to see that they use the virus as the issue. We know that this is all behind us now and it's just BS. But with that being said, these CPI numbers are being held down even greater than they should be. This is very, very important. When you're looking at this, a lot of people out there, a lot of people on the stock market, and traders, and analysts, they're looking at wanting the Fed to change directions here. But when they keep looking at core inflation and the CPI numbers in the shelter, they're noticing that it keeps going up. So with that being said, it's very tough for them to stop what they're doing unless they see some worldly issue, or of course, midterms are being manipulated. Next article. All right, I call these the FUD articles. I always say that right now, we're looking at the market being pretty stable throughout the United States. You're going to continue to see a lot of articles that say, oh, we're in a housing crash or a housing recession, or all kinds of, they use these words that are crazy words. Why? It's sensationalism. They want you to think the world is crashing around you. Now, it could be for political reasons. It could be to sell articles, to get you on their websites. This is what their idea is. If it was something subtle, that you wouldn't be there. So let's go take this Fortune magazine. Here's the headline: where home prices in your local housing markets are headed in 2023, according to Zillow's revised forecast. Well, first of all, we know that at the beginning of the year, Zillow walked away from flipping, their house flipping. Why? Because Zillow, as estimates, were so atrociously bad that they were buying houses way too expensive because they wanted to compete in that all-encompassing, market of, fix and flips, right? The iBuyer market. And they realized that they were losing hundreds of millions of dollars, just like all the other iBuyer platforms. So with that being said, they walked away, and they've actually been sued on several different occasions because of their Zestimates. So they really try to keep the Zestimates off their site. So you don't see a whole lot of Zestimates. And then of course, when a house goes active, they change the Zestimate to the active house price. But let's go take a look at this. It says shift in home values between May of 2022 and August of 2022. Okay, so we're looking at four months here, May, June, July, August. We're looking at 3 months. And we're seeing a shift. Well, of course, with the highest priced properties in the United States, most of them are on the West Coast, and the least are in the Midwest. And then, it gets pretty expensive in the South and the Northeast. Well, we're seeing that, of course, the highest priced properties that jumped up. Orange County is a very good example of this. Jumped way up too high. People are paying crazy amounts of money for them. LA County, same thing. They're starting to come down now, but we're still higher than the year ago. Well, let's go take a look at this. That's what we're seeing on this map right here. I think it's pretty funny that this is what Zillow has come out with, but ultimately the bottom line is across the United States. And if you look at this in the last 3 months, you'll see the majority of the United States is gone up, not gone down. Of course, I'll make my point one more time clear. If you look at the overall numbers that the media is giving you, it shows a recession. When we're looking at this, which I'm not 100%, I don't think it's 100% accurate. The majority of the United States shows we're not in a recession. We're not in a housing market crash. We're actually doing good. It's a stable market. Just like I said before, it's a stable market. Next article. But here's the big FUD article in Forbes. Housing market crash of 2022. What to expect as interest rates rise. Now, I laughed my ass off when I read this article. Let's go take a real good look at it. What are the key takeaways from this Forbes article? Number one, existing home sales dropped 0.4, not even 1%, not even 0.5%, 0.4 from July, with an overall drop of 19.99% from a year ago. Of course, the home sales are dropping. There's less homes for sale. We just did our weekly market home sales /actives on the market, and it keeps dropping. The amount of properties that hit the market are significantly going down. In fact, in the county of Los Angeles, we saw a 25% drop in the amount of homes that are hitting the market a week to week. 25% drop. Why? Nobody wants to sell their house. There's nowhere to go. I'm saying this over and over. The difference in middle class is if you own a home, you own a real asset. If you don't own a home, it's tough. You're struggling, right? You're paying rent that continues to go up. If you own a home, you have a steady 30-year mortgage. It's flat. You keep going and paying the same amount. It's non-inflation. Where you're running into rents are completely inflationary. That's number one. This is a joke. Number two, Google Trends show queries for real estate market crash has skyrocketed last month. Well, who in the hell is making them want to look that up? Let's go back to the top of this. Forbes, you're making them want to look it up. CNBC, Wall Street Journal, you guys are making them want to look it up. It's not a trend, is because the media is selling you on it. That's what a trend is. The majority of trends are that, exactly. So let's go back down. The second key takeaway is because what people are searching for. Okay, all right, please give me a real reason why you think that 0.4 is a collapsing, crashing market. Okay, here it is. Mortgage rates hit a 20-year high as the Fed tries to fight inflation to cool down the economy. All right, so let's go deep dive into this one. Why are we at a 20-year high? What happened 20 years ago? Well, 9/11 happened 20 years ago. From 1971 to 2021, rates were over an average of over 7%. For those 30 years, they were over 7%. What was the moment in which they went down? Was it because, economy was doing better? Was it because the mortgage industry decided, hey, let's create more business, let's lower interest rates? Well, what's under door 3? It's behind door 3. Door 3 is 9/11. When 9/11 hit, the Fed, and at the time it was Alan Greenspan, dropped rate. Alan Greenspan and Ben Bernanke dropped rates down to 0. Why? Because they were scared the economy would plunge, and they wanted to make overnight money cheap, right? So they went to 0. Read the books on it. It's so interesting. So that began the mortgage creation and the housing market explosion. So for the past 20 years, that's what happened. 2021, and then up to 2022, excuse me, not 2021, 2001 to 2008, what happened? The mortgage industry exploded. Housing kept going up. You allowed companies, mortgage companies, to make exotic loans, option arms, all that crap that brought in more and more people, made money so cheap. And then, of course, what happened in 2009, 2010, 2011? The whole market crashed because of the poor way that the Fed handled the whole situation. Again, when 9/11 happened, they kept rates low. They raised them up slightly. They should have continued to raise them. We started to have a really solid economy, especially in the housing market. They caused the bubble. The bubble bursts. What happens? They lower rates again, causing the next housing market. And of course, the virus of 2020 then went to zero, and we stayed at zero, for what? 2-3 years? Significantly longer than the virus actually lasted. That was affecting our society. Even though today, we're still seeing the effects of it, but it's on such a small small level. It doesn't cause interest. It caused interest rates. They should have raised rates last year, no question about it. But instead they printed money and kept it at zero, made a lot of people wealthy, and now they're crashing that bottom part of our economy. And that's what's hurting. So if I look at this FUD article, the majority, since 1971, there is no question, there's been more years that interest rates have been at 7% than there is years that hasn't been 7%. Yet they're going to make this such a huge problem out there because of two different events that's happened in the last 20 years that the Fed has made terrible decisions and has really prompted the housing market and the economy market up. So that's why I say, when you look at these things, these are all, combinations of poor Fed decisions and the government just spending out of control because they feel that the economy is doing good and the economy can soak it up. Well, guess what? It's time to pay the piper. And now we're going to pay the piper. Next article. All right, so we're sitting 30-year conforming FHA slowly floating down again. We expected to float down again. The CPI number was bad last week. It was expected to be 7.9 or 8%. It's at 8.2. Guess what? It was inhaled by the stock market. It was inhaled by the crypto market. They pumped it up. I think we're going to see in the next 2 weeks, 3 weeks, that this whole narrative of things are okay, things are all right until the Fed meets. And I don't know. We're going to find out what the Fed does, because it's going to be very interesting. If the Fed only raises 50 basis points, I think it was politically manipulated. If the Fed raises 75 basis points, I think that they were not manipulated. That's exactly what they were going to do. And that's what we see. The Fed only meets twice more this year, right? And only met 3 times in the last 5 months, actually. With that being said, we're going to see it. If it goes up 75 basis points, I don't think interest rates are going to go up that much. Personally, I think that the mortgage industry is realizing that they can't raise rates too much more, because if they do, then they're going to have a disastrous outcome as well. So they're going to go and have exotic loans such as ARMs, which I've talked about now for the past 2 months. They're going to have 40-year mortgages, which I've talked about for the last 2 months. They're going to have 50-year mortgages. I think that's on its way. I'm hoping that option arms don't come back. I think option arms are just, but 2-1 buy downs. So buying down the rate. I know that there's credit unions out there that are in the 4s and 5s that people are going to start flocking to and getting involved with. So if you're actually looking for a home, there are other ways than just sitting here taking a punch in the face from FHA or a traditional conforming or conventional loans. Thank you guys. I really appreciate all the you watching this, and any information you want to or comments you want to leave below, please leave below. I know that's been a request. They said that Emmy did a fantastic job while I was leaving. She will probably step in here or there. I do agree with one of the comments. She is better looking and she's nicer nicer voice. I get it. She is always my replacement unless you guys are yelling, Ryan, 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 Ryan. I know, that's crazy even think about that. You guys take care and I'll see you tomorrow.